And my name is Nikita Rana, and I'm your moderator for the day. A warm welcome to Ready to Invest portfolios in the US markets presented by Stockhill, Validea and Alphaniti. India's and Dubai's most effective platform for industry leaders, advisors, and investors for a more informed future of investing. Ladies and gentlemen, I want you to pay very close attention to the two takeaways from this power pack line that I just quoted. So before we start with the event, could we have a round of applause for everyone? Let's have a round of applause for everyone before we get to the event. John, I would love for you to be giving a round of applause to all our amazing future investors and investors. All right. So first, Stockhill has created the future of investing by curating and auto-magically personalizing stock recommendations for each of its elite clients. So let's start off by giving a big round of applause to these futuristic fintech fanatics. Well-deserved, ladies and gentlemen. And second, that it's India's and Dubai's most effective forum. Ladies and gentlemen, let me repeat that again. It's India's and Dubai's most effective forum. You guys are the sole reason for its success. So again, a big round of applause to yourselves. See, in life, I truly believe, and we at Stockhill truly believe, that we don't get a lot of opportunities to applaud ourselves. So when Stockhill is giving you this golden opportunity, why aren't you making the most of it? Louder. Much better. Today is all about our amazing viewers having a one-on-one with these industry best leaders. We have with us John Reese, the genius behind Validea Capital Management. He holds 2 US patents in automated stock analysis and has authored 2 investment bestsellers, is a regular at Forbes, and of course, is an alumnus of Harvard and MIT. I wasn't kidding when I said he's a genius. We have with us M.I. Taher, the head of MENA, who spearheads growth and profitability at Stockhill and is an absolute profound veteran with fintech giants like Reliance Nippon Life, HDFC Life, ICICI Prudential Life, gracing his accomplishments. So Taher, let's kickstart this session by knowing more about Stockhill, what it does, and most importantly, how does it do whatever it's doing? Could you please let us know?
Yeah, thanks, Nikita. First of all, I like your idea about applauding online. That's great. This is the first time I'm doing it. It's great. Just to give you a brief, Stockhill, basically the entire Stockhill's ecosystem sits on its big data and proprietary algorithms. Basically, it runs around close to 8.5 million data points every single day, from which it basically curates the information, analyzes and aggregates the information for the customer, which by what it means is it makes the research and recommendation easier. It also makes the fractional investing easier. And of course, without any noise, it's a very simple platform to operate. The whole objective of this platform was, instead of just being an execution, we said, how do we integrate a recommendation and research and, club with execution capabilities? That's how it helps the investors. Yeah.
Tahir, as fantastic as it sounds, I would request you to kindly break it down further for us mere models. Could we simplify it a little bit?
Yeah. So interesting. So what happens is when we were trying to figure out what to do for any investor and a wealth advisor, the most important thing is availability of information and how easily it is available. So what we've done is that's what the research and recommendation we brought into the system that makes it very easy. Second is when I talk about fractional investing, let's say if you want to buy these 5 stocks, Google, Amazon, Facebook, and Tesla. So if you want to buy each of these stocks, you need to have $7,000, just one stock each. But what fractional investing does is, let's say if you just have $1,000, but your ambition is to have all these 5 stocks, but still, you can buy part of these stocks. Let's say $200, you can invest in each, but you're still owning these stocks. So that's what it means by fractional investing. The third, when I said where it is easy and very convenient. So basically it means there are no minimums, there is no noise around it. it's nothing that you have to come with $10,000, $20,000. People who have $10 also can participate through a platform. So these are the key points if I have to highlight that.
Taher, that sounds absolutely amazing. That sounds like the maximum output. Are you trying to optimize the very dollar that you have, right? If I am correct.
True.
All right. Taher, that sounds exactly like the guidance we need. The first thing I'm going to do, ladies and gentlemen, trust me on this, as the session gets done, is I will be visiting www.stockhill.com and opening my very first Stockhill account. So, ladies and gentlemen, that's a little something in store for me. But for you, we have the biggest gift of all. Stay tuned till the very end and get exclusive access to John's golden tip for investment, along with a surprise gift that he absolutely kind-hearted to be giving everyone. Which brings us to the man of the hour, John. John, I'm fairly new to the stock industry, having started about 4 years back. By absolute pure happenstance, I invested in a US feeder opportunity. During the start of the pandemic, I thought, there goes my life savings and retirement plans out the window. But to my surprise, the only fund doing well and excellent as a matter of fact during these troubled times is the US Opportunity Fund. So my very first question to you is, what is the secret sauce? Like, what is that secret sauce that US has that you're pulling off an exception like this in times like these? And my second question would be, how does the landscape seem for US equity market in medium to long term to you?
Nikita, thank you for asking the question, and I'll see if I can give you a very good answer solution here. Let me share in sort of reverse order what is actually happening in the U.S. market that making it such a really good investment opportunity. One of the key things, and I'll share a couple of slides here, the United States economy is absolutely totally huge, $21 trillion. And to help put that in perspective, I have a little chart here that has the United States on it, and all 50 states are represented by a particular country, depending upon the size of the country's economy. And the first thing you notice is that, notice India is on the lower left-hand side. It represents one of our bigger states. But even still, each state is only 1/50th of the economy. You can have 50 of the top economies of the world all added together, just equal that of the United States. So there is huge opportunity here. As a matter of fact, the United States actually accounts for 54% of the market capitalization of all the world's stock markets. More than half of all the world's stock market. So there's a big, huge, deep market. And let me explain what that actually means further for people who invest in US stocks. One is they get thousands of stocks that they can diversify in. Second, it has to do with liquidity advantages. Almost all of the listed stocks have a relatively large trading volume that goes along with them, meaning that investors can get in and out without affecting the stock price of the market. Almost always, 99.99% of the time, there's a very active trading market going on that people are able to get in and get out when they decide to purchase or they decide to sell. There's a concept called shareholder yield, which talks about the dividends of the stock and about the return when companies actually buy back the shares of the stock. In the United States, it's generally higher on average than most country stock markets of the world. Currency benefits for people investing in the United States relative to, let's say, India. Over the last 10 years, it's interesting, but if you just had your investment or savings in the United States and held on without even investing or getting return in the stock, your funds would have appreciated by some 63%. Now, those are trends that go up and down in terms of the exchange rate between Indian rupees and US dollars, but right now that trend is still expected to continue for the long term. So you get a tailwind when you invest in US stocks from the currency exchange helping you when you take your funds out. And finally, what I call structural edges in the US market are very important. The US market has the cleanest legal system, the highest degree of regulations, and the highest screening on the reporting of the accounting information of the company. 99.9% of the US companies adhere to the very high reporting standards, meaning the data and the accounting data that you're getting are clean, and meaning that when you make decisions based upon the company's representations of their sales and earnings and other key characteristics, you are getting pretty accurate information. And this is not true in a lot of stock markets around the world. So there are legal and structural edges that you actually get in the US stock market that are big advantages. And one other key thing is, maybe this is obvious, but world's leading companies, the majority, are located in the United States, such as Apple, Microsoft, Facebook, Netflix, Amazon, Google, Starbucks. And one of the reasons these companies are located here are because of the universities, again, the top universities of the world, such as Harvard, MIT, Yale, and Stanford, are here, and they continually feed a ecosystem of innovation, and eventually some of those companies grow up to be very, very big, successful companies. So all of these are reasons that the United States is basically in charge. Now, in terms of a secret sauce for basically staying on top of the market or having good results, let me see if I can share some strategies that we're doing. And this may take a little bit of time, but we have a process that starts by identifying proven investing strategies. And that's a real important key right now, because when people get involved in investing, they're usually all over the place. They have a tip from their relative or their friend. They're starting to read the news. They hear about a company from their own practical experience. Perhaps they start to read books and articles about investing. But one of the things that we do is we look for already proven investment strategies to start with. And then we construct computerized models. So we don't just do it ourselves, but basically we turn it into a computerized, artificially intelligent model that follows the investing strategy or the legendary investor and applies that strategy to all the stocks in the stock market. So again, when most people do it, they look at just one or two stocks. After all, if you're analyzing a stock, even as a individual investor, it's easy to spend 2 hours per stock. When we have the information and the databases of accounting information, the computers are able to go through this extremely easily and pull out the data and apply the proven formulas to several thousand stocks each and every day. And that's part of it. You're not just limited to the one or two stocks that come to your attention or that you are focusing in on or that you're interested in, but you're actually looking and comparing against all the stocks in the stock market. Part of the process is to actually turn it into a process. So you don't just do this once, but you do it over and over. On a monthly basis, we do what's called rebalancing the stock. So every month we look at what are the stocks that are doing extremely well according to that strategy. And those are the stocks that we purchase that month, and we take out the ones that are performing the least well according to that strategy. So we repeat this process very methodically and over and over. If I had to get down into what we can call the science of the entire process of what we do, I'll give you an example of two key strategies. The first one we'll call the growth strategy by Mohanram. And these are more expensive stocks generally, that you can look at the consistency in the fundamentals of those stocks and the consistency, how they compare to the competition, and select those stocks that will tend to outperform. So more specifically, how it does that, still keeping this at a high level, is the strategy looks for low book-to-market stocks that are associated with fundamentals that themselves are associated with sustained future growth. And where does this strategy come from? There is a paper by Pabrath Mohanram looking from 1979 to 2010 that generated a return of 20% versus the S&P 500, which was 11%, or roughly about half that. And the investment thesis here is that expensive stocks generally underperform the market. But when you apply a series of criteria, reinvestment criteria and strength criteria, you can identify outperformers among expensive stocks. So top growth names have been really performing well in the current market environment over the last several years, and this trend looks poised to continue. That's a high-level overview from a more general point of view. I want to share more of the science behind it. What does this really actually look for? What are we talking about? If you wanted to do this on your own, what key characteristics should you be looking for? So let me share that with with you. So the first one is a growth stock filter. What does this really mean? Basically, it needs to trade in the bottom 20% of the market based on the book to market ratio. Now, what is the book to market ratio? Most regular investors have heard of this as the price to book ratio. This is one of the most common metrics used in looking at examining companies. So this particular strategy looks for the most expensive stocks according to this metric. Next big category is the profitability and cash flows that we actually look for. And this methodology rewards both profits and cash flows. Both cash and profits can measure different aspects of the profitability of the company, and it's important to focus not just on one, but on both. More specifically, there is the return on assets. So here's a company, it's worth several $billion in terms of equity or in terms of borrowing, and you want to compare the profitable return on those assets to that of the competition, its industry competition. And it scores a point if it actually does that. You can look at the cash flow from operations to assets, compare that to the industry average. And again, assign a point if it actually beats the industry average. And then you want to compare those two numbers just for the company itself, the cash flow from operations to assets and to the return on assets. Basically, you would like your return from your cash to actually be higher than your return on assets. So this indicates a very profitable, cash flow successful company. A third set of criteria has to do with the variability of the business. And this is really key, it turns out, to this particular model. Most investors are not set up to really look at the variability in the return on assets and the variability of the sales growth. But you really need to look at the past 5 years and see not just how has the performance been, but how consistent has it been from year to year. So that is really part of the secret sauce. And of course, the more consistent it's been, the more likely it's expected to do in the future. It's extremely easy for investors to be distracted by a huge growth in 1 year of the business or the most recent year. And what's important here is that you're looking for low variability over the past 5 years. Investing in the future, you want to compare to the industry averages what percentage of the budget is spent on the R&D, what percentage of the budget is spent on capital expenditures, and what percent is spent on advertising. So these are part of the criteria. Now, it turns out that this doesn't contribute quite as much to the overall success of this model as the variability in the business actually does, but nevertheless, it's still a key point of the model. So there are 8 different criteria that are looked at for each individual stock. And as I mentioned, many are compared to the industry average. And by summing all the scores into what Mohan Ram called a G-score, you can identify the top stocks, and generally you'll take the top 20. So what I hope I just shared with you for this one particular model, which is doing really well, is that it looks at a lot of criteria that are honestly very time consuming as an individual investor to actually focus at. And it's very helpful to use a computer model and the stacks, as we call them, to actually do this work for you. But it's important to know the strategy and understand the strategy so that you have conviction in it and believe that it can actually pick out the more successful stocks. And if I take a moment, because you really asked for sort of a detailed question, and again, the science behind it, we have a second model that we call the twin. Actually, before I do that, let me actually share you the success or the performance. Basically, since 2006, this portfolio has returned just under 400%, and that outperformed the market by 245%. In simpler terms, a simulated $100,000 investment in 2006 would have grown to $500,000 today, and you can compare that to just $200,000 if you had a comparable investment on the S&P 500. And this should be pretty impressive numbers to the typical investor. The twin momentum strategy at the highest level is you're buying stocks with strong price momentum, and you're also buying stocks with improving fundamental momentum, and you're combining the two. So this strategy came from a paper, Twin Momentum, Fundamental Trends Matter, by Dash and Wang. And this produced more than double the returns of just a price momentum strategy or a fundamental momentum strategy standalone selection criteria. So the thesis is you can generally have success above average stock market returns by following a momentum strategy. And again, I will emphasize that this is over long periods of time. And you can also have success by following the fundamentals of a particular stock over long periods of time. But you will have more success if you actually combine them and look at them both. So this strategy in more detail looks at the trend in 7 key fundamental factors. So the fundamental factors are earnings, return on equity, return on assets, which you will recall was also used in the growth momentum strategy, accrual operating profitability to equity. So accruals are important because there are differences on the company's book between what they say they spent and what they've actually spent. You'll generally book expenses and income in the same period of time, but that creates differences in how much cash a company actually has on hand. Companies that make aggressive use of accruals actually tend to underperform the market, according to various research studies. cash operating profitability to assets. So this hard numbers. What's the company returning in terms of cash compared to the amount of assets invested in the company to get there? And you can also look at that at gross profits to asset ratios. And this is actually before you consider the sales and R&D, but this is after your cost of goods sold, again, comparing this measurement to assets. And finally, the net payout ratio looks at the amount of dividends that the company is actually sharing with the stockholders in return. It might be 0%, it might be 10%, it might be 50%. But generally, the trend of that going up is a very positive thing. Now, those are the accounting momentum key criteria, but there's also price momentum, which a lot of people are familiar with when they're looking at charts and they're looking at the relative strength of how is the price of the company done, compared to 12 months ago. With the twin momentum strategy, it uses what's known as the 12 minus 1 relative strength. So 12 months ago minus 1 month ago recent strategy, not the most recent month, but 1 month prior to that has been found to essentially be optimum for price momentum. And this particular strategy incorporates that. And again, part of the secret sauce is it now combines the fundamental momentum criteria and the price momentum criteria, comes up with a score for all the stocks in the stock market according to both, and then takes the highest 20 of those particular stocks. So this particular strategy and stack, basically $100,000 would have grown to $600,000. To be perfectly clear, you might ask, well, okay, the one that I just showed before this, 100,000 grew to 500,000. This one grows to 600,000. This is clearly superior. Should I put all my money into it? And the answer is no. And the reason for that is what we haven't talked about is that all stocks strategies have some sort of risk to them, and there's a lot of this variability in terms of how well it does. The twin momentum strategy has a lot more ups and downs in the strategy than did the prior growth momentum strategy. And that becomes an important factor because to experience the benefits of this, you have to stick with the strategy. And when stock strategies drop by many, many percent, there's a very strong tendency in all of us, me included, to say, hey, has the strategy stopped working? Do I need to leave it? Do I need to exit the strategy? So the more prudent way is when you have high performing strategies like these is to put a portion of your investment into both rather than just one. So I think maybe I gave almost a too long answer, Nikita, to your question, but I'll turn it back to you.
In the meantime, there is a question come up, Nikita. So I just wanted to take up that question. There is there's a question which has come up, which already a customer, one of the, viewer is asking about, can I transfer money from Bank of Muscat online transfer? Can I do it from Oman? Anyway, it's a little offbeat, but I still wanted to answer till John takes a break. Yes, people, Stockhill customers outside India, people can go on to their bank account, just add your trading account details as your beneficiary account and make an international fund transfer to your trading account. So in maximum 2 working days, the funds will be credited, and after that, it will be available for you to trade. So that's how it is. There's another question come up, which is asking about how safe is our money and how safe is the account. Just want to answer that all these financial institutions are highly regulated institutions, so there is no exception to this. So basically, our underlying clearing agent is Drival, which is registered in the US. And this company is registered, regulated by SEC and FINRA. So I call the mother of regulators around the world. And your account is safe, your money is safe, and it is further protected by SIPC, which covers about $500,000 of insurance for your, for all your assets. And to top it up, Citibank is the custodian. So net, all I want to say is that holistically, the entire ecosystem is protected by the regulator. So it's pretty safe. And what I'll do is now I'll let John speak and then I'll pick up other questions. Thank Nikita if you have anything. Yeah.
Sure.
Thank you. Sorry for the interruption. So as I was explaining, part of the science and part of the secret sauce is a momentum strategy, a growth strategy based on Mahanram. There's an insight within the growth stock universe.
Okay. Thank you, John. Yeah, Nikita. Yeah.
You have to start really young. John, am I correct?
You are correct.
By the way, John and Taher, I mean, our comment box, our section is just being overflooded with questions.
So,
and Taher, I'd love for you to take it up.
Yeah. There's an interesting question, John, followed by a presentation. Since elections are very close, which are scheduled for November this year, so people want to know how will the presidential election impact the stock market? Is it a good time to invest now, or should we wait till the elections and then take decisions to invest?
Well, you've asked a really good and actually tough question. So the research history shows that in general, overall, over a longer period of time, the actual elections and politics that go on don't actually correlate very well with the stock market itself. Now, that said, there's some research that shows that in the short term, like right after the election, if the incumbent wins, the stock market could go up, but not by much, maybe by 5% on average, and that's not what I would call a reliable number. 30% of the time, that's not what happens. But then in the following year, when that happens, all that loss is essentially made up and it goes higher. So another perspective or overlay on looking at this is what happens if a Democrat wins versus Republicans. In the United States, there's the general impression, although it's not correct, that when the Democrats are in power, the stock market does worse than the Republicans, because the Republicans are considered very conservative, they want lower taxes, and the Democrats are generally considered to want to spend more on social programs. But history actually shows it's just the opposite, that when the Democratic presidents are in control, most of the time, not all the time, it's not 100% rule, the stock market does a whole lot better. So another key way of looking at this is what generally it's considered that taxes are going to go up if the Democrats take control, and that's bad for business. Well, in this particular case, the United States has just spent $3 trillion and may very well, over the next 3 to 6 months, spend another $3 trillion in pumping money into its economy. No matter who wins this election, taxes are going to go up. So that removes that factor from this. So the whole bottom line is, no, there's no reason to essentially wait. If you have a long-term investment strategy or allocation to the US market, there's no smart way to say that, hey, yes, you should wait, or no, you should wait for this particular timing. Again, various commentators may offer various opinions on that, but the research shows that you can't reliably predict a stock market decrease or a stock market bump based on the US elections.
Sure. Thank John. I think it just summarizes the entire, what you mentioned and the question. And just followed another question is, now you mentioned about the thematic portfolios, and I think it's pretty impressive that over the years it has given consistent 30% plus kind of returns annually. So one of the question is, what is the ideal time horizon one should look at investing in these thematic portfolios?
Well, let me just back up a second to add some clarification to your question. Because for full honesty and investing knowledge, 30% is probably misleading when we say that it is reliably occurring every year. That is the total compound return over a period of time. And in any given year, in both our strategies and frankly, in every single strategy that I've looked at in the stock market, and I've now examined some 200 strategies as candidates, they all have variability from year to year. There are good years when they can go up by 60%. There are bad years when they can go down by 30%, and they can go down even more during the year. So the variability is always there. But we look at the long-term success of a strategy. And honestly, as I mentioned, we also look at the variability of the strategy when we want to actually go forward and use it in live portfolios. So if you would re-ask your question about what is it, the 30% returns and the, what would you like me to try to get to again?
Yeah, no. So I think the question was, what's the time horizon? How much time should I be invested in these thematic portfolios? Is it 3 years, 5 years, or what time I should?
Yes, actually, that is the right answer. 3 to 5 years generally is the right time frame, and longer. Many of these strategies can go on runs for that period of time, or even for a decade or more. And you need to give it a long time to work. What you don't want to do for strategies is to be in and out of a strategy, you know, in a month or in days. It's really trading, that's really speculation, that's really gambling as compared to taking advantage of these research trends that are in these strategies.
All right, viewers, you've asked our panelists such interesting questions. It is now time for us to know more about you. We have a poll where we'd love to know your thoughts on. So, you know, there's a live poll going on, and the question is, which theme do you expect to do well in the US in the foreseeable future? Your option is A, technology and communications, B, blockchain, C, healthcare and biotech, D, consumer discretionary, and E, clean energy. And we would love for you to just hit your answer on the poll in the next 3 seconds. So I'll be doing a counter of 3, 3, 2, and 1. So let's see how many of your viewers, you know, think that the next big disruption and revolution will be caused in the field of. Taher, we would love for you to do the honors.
So about 59% have said technology and communication, and then about 14% in blockchain, and healthcare 20%. So I think technology and communication takes the cake, and that's
a landslide win. I see the 0% for consumer discretionary. I mean, consumer is king. But clearly technology and communication wins. Thank you so very much to all our investors and future investors. All right, John, over to you.
How does it really benefit the individual? Well, 2 things. It dramatically reduces the risk that they have. So compared your again, particularly United States market, you have less risk than other markets. You are diversifying among a already successful set of criteria to pick stocks. So risk reduction is the one key benefit. The second has to do with the tremendous reduction in time. Professional investors are obviously spending all day, 5 or even 6 days a week, researching and deciding on what stocks they want. Most retail investors simply don't have that time, even when they're passionate and really interested. At best, they can spend an hour or 2 for a particular stock. This way of using the themes and the stacks means that a computer has gone through all several thousand stocks in the market by a very consistent, proven successful criteria. And it's much better and easier for the retail investor to use that and end up with properly diversified portfolios. So tremendous ease, tremendous time savings is the other benefit of these strategies and using these stacks.
John, I should have known better. Considering we are in communication with a professional like you. The very first time you ask a question, you explained it with such crystal detailed clarity. And thank you so very much. So I believe the crux of the second question was how will it then benefit our lovely investors? And it boils down to saving your time. And when you have a veteran like John, who's dedicated his entire life into this, you know for sure that your time is being saved. Tahir, our question box is just being flooded with so many questions, and we would love for you to, take ahead a couple of questions.
Yeah, yeah, good. Okay, firstly, I just want to, it's amazing that John already has a fan. Somebody really likes John, and he said he's really amazing. Thank John. That's great compliment for you. Okay. So yeah. So one of the interesting question is, does stack take into my risk profile and suggest the risk stack for me? Let me take that question. Yes. So what happens is when you onboard, when you become a user. So technically there is a risk profile which you fill up. Every stack has its own description, and it completely discloses what sort of risk it carries and what sort of upside and downside it has. So with these two combination, yes, you can decide what stack suits you. That help if that helps you. Yeah, that's one. Uh, Another question which has come up is, so he wants to understand the complete whole fund transfer process from India to the US. Just to let you know that Stockhill has created the entire ecosystem for fund transfer from India to US, which is under LRS, and it has automated the entire process. So once you become a user, so inside our ecosystem, there is a fund transfer process. So it's a seamless process. It connects to your bank, and from your bank, it automatically gets debited and credited back to your US account. So just to answer, yes, it's completely automated now. Whether you want to transfer $10 or India has a limit of $250,000 to whatever amount you want to transfer, everything is automated, if that answers you. And one more interesting, John, for you is that a lot of people, when I talk to a lot of fund managers, they don't capture, they always shy away from this price momentum. So every time we talk to fund managers, they away from certain technology stocks because of the kind of price momentum it has carried. Very interesting to see that in your twin momentum, you have fundamental and price momentum you carry. So how did the thought come up for you to carry this price momentum for you?
The price momentum comes because it was actually part of the strategy. So I had set about many years ago looking for the best strategies in the market. And at that point in time, I read some books from legendary investors. Peter Lynch was one, Warren Buffett was another. And I was able to extract the knowledge and wisdom from those books and what they used for selecting stocks. Later on, I turned to academic research papers, and one of those papers was from Dash-Un Wang, who had the twin momentum strategy. So I can't say that I came up with it, but I felt that there was a lot of valid basis to combining it together, and his statistical research results validated and proved that you could combine that together and have the performance of your portfolio twice as good as if you used just one of the momentums alone. One other little background is that there are several factors that the academics all around the world have discovered help power stock markets over a long period of time. One of the most powerful ones, when used according to how the researchers define it, not necessarily how according to most popular investors would define it, is the momentum factor. There are other factors like value that can be used, and the momentum strategy, believe it or not, even though it had momentum, also had value factors in it. So momentum is a well-known, established academic factor, or at least I should say the price momentum is. And then Dash and Wang came up with establishing the momentum of fundamental factors, which had been used relatively little before that. So we have to credit him with the strategy.
Great, thank John. And over to Nikita. If there is any more time, I can take question. I will. Otherwise, it's over to you.
We do have time. We can take a couple more questions, because you know what, this is such a golden opportunity for John and his fans to have a one-on-one. Who knows, on this very platform, when do we meet John next? So let's make the most of it. Let's take 3 or 4 questions more.
Okay, fair. So another question, which probably I'll answer. One of the users asked, "Can I transfer stocks from one, broker house, that is Barclays, to Stockhill? If yes, the process." So yes, so you can transfer your portfolio from one broker to another to Stockhill. What I recommend is, it's a lengthy process if I have to give it away. All I would request you to go on to stockhill.com. At the bottom right, you will have a button called Get Help. So if you click on that button, you will have a live customer service executive, which will help you with the entire process. So if that helps you. Yeah. So another question, John. So one of the thing is the general myth, one of the user is asking is the general myth around investing in developed countries is that not much scope for upside. How true is that as an outlook?
Wow. So no, first of all, the United States' development economy is a real powerhouse and just keeps going and going and going. That's not to say that it does not have its ups and downs every year, but do you really want to bet against the American economy over the next 10 or 20 years? That's a way of wiping out your capital if you do. So no, there's plenty of opportunity within the United States as a whole. And again, as I mentioned earlier, the United States has a lot of the world's biggest, best, progressive, highest technology companies. Again, when we talk about Google or Amazon or Microsoft, just as examples, and those stocks over periods of time still have the potential to do very well. Now, and those stocks are there, the companies are there because of the innovation of the American educational system, the American universities. And those are still extremely strong in terms of feeding people. If anything, the entrepreneurship and the innovation over the, I first went to college, at this point it was more than 40 years ago. At MIT, there was an emphasis on entrepreneurship as compared to other colleges, including like Harvard Business School. Right now, Harvard Business School at that time had one professor, as an example, a professor of entrepreneurship. Now, Harvard Business School has 22 professors of entrepreneurship. The ecosystem supporting the innovation and students and academics who want to go out and invent new things and invent new companies is 10 times bigger than it was a number of years ago. That has not stopped. That has dramatically increased. So no, I completely disagree with the assertion that in developed countries, innovation has slowed down, and as a result, the stock market doesn't hold much potential. I totally reject that.
Yeah, thank John. I totally second that. I was just researching about a couple of themes last time, what we were talking about 12. So one of that, just one theme, which is 5G. Just to give you a perspective, in next 10 years, that's going to generate a revenue of about $13 trillion. That's the kind of revenue just with one innovation which is going to happen. And again, most of these companies are back registered, or the innovation is happening in the US. Number two is that what this 13 trillion translates is the number what you were showing on your slide, which is US is $21 trillion. If you peg this opportunity against it, it's about 60% of a US economy itself, just produced by one single theme. So imagine the other themes, what kind of disruption is going to create. So I think in next 10, 12 years, there's going to be a whole lot of a new world in terms of investment, and interesting times to see in the US. And to club that, what you mentioned about the currency exchange itself, which is going to, in last 5 years, it was about 63% was the currency, gain. Uh, Mind you, this is important for people who are living outside India, how important it is to hold in currency, in dollars, and also invest in dollars. So you have two folds. One, you get a currency appreciation gains, and also you're going to get the US market gains. So that's how you enhance your returns. Yes, Nikita, thanks. Thanks for the patience, and over to you.
Absolutely. Investors and future investors, what we have today are the absolute industry best with an ocean of experience and knowledge. And for our next question, we want the two of you to convert that knowledge to a one liner. Okay. So it's a rapid fire question. And the question is, what is that one must have trait of a good investor? John, what according to you, in not more than a one liner, is a good trait of a good investor?
Long-term patience.
Wow. Okay. Tahir, what
Um,
about
So yeah, just to sum, so this is through my personal experience. What I follow is I follow this venture capitalist and private equity firms. What they follow is that they do a lot of research on a company first before they invest. Then once they invest, they don't get out. They have patience. They invest, reinvest, and reap the benefit over a period of time. So that basically sums up everything, right? So you're going to research well, and you're going to invest, stay invested, add more, and reap the benefit over a period of time. So I would go with that.
Wow, I hear the keyword patience being used twice. So,
Yeah.
ladies and gentlemen, patience is the key. Patience is the key which gets you richy rich in a couple of years, but it will surely happen. All right, absolutely fantastic. Ladies and gentlemen, John and Stockhill team is ever so kind. John is an expert, like I said, he's an author as well, and he's authored this amazing book, of which every point that he's mentioned right now, because we've run out of time, but rest assured we have something back of our mind, we've got it backed up. We'll be sharing 2 chapters of his book, and yes, it covers just about every point that John, because he's running out of time, would have mentioned. All right, ladies and gentlemen, with this we come to the end of today's session. Visit www.stockhill.com to open your Stockhill account, and do talk to your advisor to know more about a thematic portfolio. Thank you very much, John and Tahir, for your absolutely valuable time and insights. Thank you so very much